Hello and welcome to Count on Our Simplified Advice, a 360 podcast that talks all things employee benefits. My name is Nicolette Mashile and I'm joined by Riccardo Fontanella, who is the head of technical marketing at Alex Forbes. Now, his team of specialists deliver intermediary marketing services in the investments and retirement space. And I'm quite excited to have you here today because we're talking about expectation versus reality. I mean, how often do people start going into like an investment journey? However, within like 2 years, they're like, how much money have I made? What have I made? What does it actually look like? And I think that's the conversation that ideally I really would like us to have. But before we get into that, Riccardo, welcome.
Thank you, Nicolette. Yeah.
I want to find out from you, just so we can understand where Riccardo is, right, mentally. What football team do you support?
Okay, well, I think most people will be disappointed to know that it's not an English Premier League team.
Okay.
So it is Inter Milan.
Okay.
And unfortunately, we finished second this season to our rivals, Milan. But next year is another season and another game.
Tell me why them?
I suppose just growing up in an Italian household, they're one of the biggest clubs, and one of my favorite soccer players of all time, Roberto Baggio, had a stint there, and I kind of stuck with it. I grew an affection for the club, and through him, I think that grew even more.
All right, so that's quite interesting. So you say you are South African Italian, right? What is your favorite Italian dish?
Oh, that's a tough one. I would say it is probably orecchiette, which is, I don't know if you've seen those, they kind of they look like shells, like flat shells with broccoli and potatoes. It's a very southern dish. That
it has no meat?
No meat.
Riccardo. And who makes it better, your wife or your mom?
That one, my mom.
Oh, really?
That one, my mom, yeah.
I hope your wife is not watching right now because she's just like,
No,
sir.
she'll attest it.
And which meal in South Africa would you say comes close to it or reminds you of that meal?
Oh gosh, I don't know. I would say, let me balance it with a meat meal or one that I really like.
Yes, please.
There's nothing like a good braai. Any meat I like. That's me.
I think you're going quite conservative on that one. You're just like, listen, a braai is safe for all of us, right?
It is.
With your Italian dish, though, when I asked you who makes it better, mom or wife, you went very aggressive there. You're just like, my mom, and there's no chance of it. And I think that's what the conversation is about today, right? We want to really understand that if I am taking my salary income and I'm putting it into an investment, what does that actually look like for me? What can I expect? And what type of support should I be getting from my employer as part of my, my employee benefits? Are they actually going to support me? Is there somebody or a specialist that I'm able to contact to be able to have those types of conversation? And I think let's kick it off by talking about, the relationship that does exist between risk and return, because we've been taught for many years, high risk, high return, So we all go aggressive, but what does it actually look like?
Okay, so I think when we talk about risk and return in investing, what I always like to do is to start with a real world take on it.
Okay.
So I suppose the starting point there is to understand that risk is a part of life.
Yes.
We face risks almost on a daily basis. Some of these risks include us driving in our cars, to something even bigger and more global, like being part of a broader global pandemic and all the risks that go along with that.
Yes.
So we have a situation where you are experiencing all these risks on a day-to-day basis. Some of these risks we want to avoid completely. Some of these risks we want to prepare for, and we can prepare for them. But there's also those risks that we are actually willing to take because there's a good chance that they could pay off quite handsomely should they go our way. And it's pretty much the same in investing.
Okay.
Risk and return go hand in hand. They're essentially two sides of the same coin. And I think before we delve into the relationship between risk and return, I think it's important to just touch on those two concepts quite briefly. So I'll start with risk. So when we talk about risk in investing, I think the most fundamental thing for people to understand is that risk could mean a number of different things to a number of different people.
Yes.
So what I mean by that, some people could view risk as the probability of losing either some or a big chunk of their money. Some other investors or people might see risk as how drastically their rand savings can fluctuate. In other words, how drastically it could swing up and down with the movements of markets. And then to some people, risk could mean quite simply just not meeting their investment objectives or the investment goals that they set out to achieve. And so what you have is a situation where all these risks exist in investing. They're all different. And you often hear these terms, risk averse, risk seeking, risk neutral. And what these terms are just ways that we use to identify people's risk tolerance.
Okay.
So what is their tolerance for risk? What does their risk profile look like? How do they view risk?
Yes.
How do they perceive it? How do they respond to it? Because if you can understand that, you can understand how it's going to ultimately influence their personal investment decisions.
Okay.
So that's risk.
Before you move on to return, how would I be able to calculate that? Is there a calculation? Is there a questionnaire? Is it like a psychology room where I sit? How does one calculate what their risk profile is?
Yeah, so there are questionnaires that you can take.
Okay.
Usually when people sit with a financial advisor or financial planner, they will have a set of questions that they will ask you just to kind of feel for where your risk tolerance levels lie. And those are very pointed questions to try and get what that risk profile is. So, you could do these tests. They're available online. You can find out how your relationship is with money. Are you willing to depart with some of it?
Yeah.
Are you willing to take more risks that you know that you're going to get a bit more on the upside? So those questions do exist.
But Riccardo, I would assume that your risk profile kind of is shaped by your life stage, right?
Absolutely.
So if you're having a baby, if you're anticipating being pregnant, your risk profile will change.
Yes.
I mean, at this point, I have no children, so I'm just like, let's go, right?
Yeah.
But I'm assuming the moment I start building a family, my risk profile will slightly differ.
Absolutely.
So do those life events really play a big role?
Absolutely. So when I mentioned earlier about pointed questions, those were the kind of pointed questions. So, we need to understand that we're all unique. We all have our own personal circumstances. And based on those circumstances, going to identify what needs we have and what objectives we might have.
Yes.
So that's a very valid question. Yes. So personal circumstances are going to shape what investment you're ultimately going to go into and how it's going to be structured.
Makes sense. Yeah. Let's talk return.
Okay, so return is pretty straightforward. When we talk about return, what we're talking about there is the growth of your money.
Okay.
In other words, the additional amount that you earn over and above your initial investment. So that's risk and return. The return's pretty straightforward. I think now that we've got an understanding of the two, we can go into the relationship side of it.
Yes.
And the first thing for listeners and people to understand is that the relationship between risk and return is quite strong.
Okay.
So generally speaking, the higher the risk that you're willing to take with your money, the higher the expectation of higher returns.
Okay.
And I've been very careful with that statement, and I've used expectation deliberately.
Yes.
Because higher risk doesn't always necessarily translate into higher returns. Higher risk is what it explicitly means.
Yes.
It is that you're taking on higher risk with your money.
Yes.
And, it's for that reason that investors and people in general would naturally want to be compensated for taking on high risk with their money, for accepting high chances of losses with their money. And that compensation comes in the form of high expected returns. I think, if we were talking about examples earlier,
yes.
I think, we could go back to a real life example and we could look at an employee whose line of work is quite a dangerous one. It's fraught with risks. It's fraught with lots of hazards. So we could naturally assume that this person would expect a higher salary for the job that they're doing because of all the risks and the hazards associated with it.
Like those guys who drive those money cars. Like every time I see them, I'm like, why would you go into this job, guys? Because you literally are a target every single time you move.
I mean, the first one that comes to mind for me are those guys who work on the oil rigs. Having to dive and weld underwater. I mean,
that's true.
So high expectations of a high salary there.
Okay, and makes sense.
Yeah, and it's the same when it comes to a risky investment. A risky investment must provide investors with the potential of high returns to compensate them for that extra risk that they take.
Okay, no, but here's a question now. So why then do financial experts like yourself then have like a big heart attack when these guys, these Forex guys come up and say, well, double your money in 3 days? Because clearly they're selling the high risk, high expected return, right?
Yes.
Yeah.
So I think there we got to differentiate between what's sensible and what's too far-fetched.
True.
So I would say, in the financial services world, if you're in this industry, you know what a reasonable return is. You can contextualize it with what's happening in the economy, the global economy, the local economy, macroeconomic factors globally. And you can kind of make an assessment of, what's a reasonable return outlook. So those numbers do stand out quite clearly.
Yes. And I think anybody, if you are at home watching this right now, if you think something is too good to be true, it probably is, right?
It probably is, yes.
Especially if it's got like no base of why you would get such a return. Because I just think sometimes people, and perhaps maybe we'll talk about this a little bit later on, where I want to find out from you, in the time that you've been in this space, what creates those those unrealistic expectations from people when it comes to their investments. But we will speak a little bit about that. Let's talk a little bit about, I want to get the maximum returns. I really want them, because at the end of the day, what am I doing, right? And you said the market does try to compensate if you are going to go for that little bit riskier investment. How do I mitigate to make sure that I do get the maximum returns?
Okay, so I think the first point here is that the risks associated with investing cannot be eliminated.
Okay.
Every investment is going to come with some level of risk. And unfortunately, the reality is there's no such thing as a no-risk investment.
Okay.
But having said that, I think, the good news is that just as in life, you can prepare and you can manage for risk. And if you look at your most successful and experienced investors out there, many of them will tell you that to spread your money across different investments, such as equities, bonds and cash, and to even do this across different currencies, regions and sectors, that spreading process is probably your best line of defense against the market's uncertainty and all the risks that go along with that. And the reason for that is because when you spread your money across these different assets or investments, it's very unlikely that they're all going to move in the same direction at the same time and at the same rate in response to a specific market event. And so this concept of spreading your money across different investments is what we call in investing diversification. So more commonly, people would have heard of the expression, don't put all your eggs in one basket.
Yeah.
And that's become a very popular expression to reference back to the concept of diversification.
Yeah.
But I think perhaps, maybe I can share an analogy with you.
Please do.
This is an analogy that I've come across and that I share extensively with my clients and colleagues as well.
Yeah.
And I think it's an analogy that really hits home the importance of diversification and how it can actually benefit investors. So Nicolette, let's assume we have a standard glass window pane.
Okay.
It could even be this
like
one,
this one.
like
Yes,
this one here.
yes.
All right, so a standard glass window pane. And let's assume we have a rock and we throw this rock at our window. All right. The question is, what is going to happen to our window? And the short and obvious answer to that, which I'm sure you agree with me, it's going to break and it's going to shatter into pieces.
Absolutely.
Okay.
Yes.
So let's assume another scenario now.
Okay.
Let's assume that we decide now to add a frame to our window.
Okay.
Or add frames.
Okay.
So we add one frame in the middle, top to bottom.
Yes.
And we add another frame in the middle, left to right.
Okay.
So what we're essentially left with is a window with 4 glass quadrants.
4 pieces, yes.
4 pieces. Okay. Let's go back to our analogy. Let's take our rock again and we throw it at our window.
Depending where you aim now.
Depending where you aim.
Okay.
Right?
Yes.
Chances are, the question is going to be what's going to happen to our window.
Yes.
And chances are you're going to break only a quarter.
Yes.
So only one of those windows is going to break and is going to shatter into pieces. Let's continue this analogy. And if we continue going, we keep adding more and more frames.
Yes, and you keep getting
eventually what you're going to get is something that looks like a fly swatter. Then more than a window.
Yes.
But to us, that's not really going to matter because any rock that we throw at this window is not going to do much damage.
Absolutely.
Okay, so the point here is that for the listeners and people tuning in, investing can be a place where a lot of rocks can be thrown. We don't know when they will come. We don't know where they will come from.
Yeah.
But what we do know is that it's probably a good idea to make sure that your investments have enough frames to withstand the impact.
That's such a smart analogy because it's actually a visual analogy. And I think for anybody to understand it is quite easy because you can actually see the little squares. As you were explaining it, I'm seeing the squares, I'm seeing the rock coming, and it's knocking the one part. And I think that's what also happened during the COVID, especially during the hard lockdown when the economy kind of slowed down. You saw certain asset classes taking a bit of a knock and some not taking. But even within the asset classes, I mean, if in property, it was, commercial property was taking a knock. So I really like that analogy.
Yeah, and I think, that's, you talked about the visual aspect of it. If you take the frames and you replace them with different types of investments, so you keep adding different types of investments to your investment plan, obviously to the point where it makes sense. You don't want to diversify too much.
Absolutely.
But if you do add more investments to your investment plan, you can see how diversification is a really neat and easy way for investors to not only minimize their risk and safeguard their money, but also to maximize returns. Because what you're essentially enabling yourself to do when you diversify is to still earn a return off one investment, even when another is performing poorly. Or, to go back to our analogy, even when one is broken. And I think this is probably the point that is most critically important for people and people going into the investment world, is that it's a lot easier to live with and stay disciplined in a portfolio that still allows your money to grow while still managing risk at the same time. And for me, that's the beauty of diversification. It's taking advantage of the good, protecting yourself from the bad, and maximizing your returns as far as possible.
But how do I diversify, Riccardo? If I'm just an individual at home, started off in the beginning talking about the fact that a majority of the people that are going to be watching are investing with, salary money. And it's in South Africa, we know salaries are not as great as they should be. So already I'm feeling stretched, but I do want to invest, I do want to make sure that my money is growing some way. How do I do that mitigation? Who helps me with that?
Okay, so this is where the help of a professional financial advisor can come into play. So financial advisors can really have a look. And again, it talks back to your risk tolerance, your circumstances, your needs. What are your objectives? What are you trying to achieve with this investment that you want to make? And that will define your level of diversification. A financial advisor, he will tell you or she will tell you, that this is the perfect blend, or this is an appropriate blend of assets for you to have in your investment. Typically sometimes people are aware of the risks, and sometimes they are happy just to be in a portfolio that just invests in the likes of equities. They have a maximum return objective. They maybe have other savings pools. They can stomach the risk that comes with that. So it doesn't mean necessarily that they need to diversify. But, for the most part, a lot of people do have a level of risk tolerance, and a financial advisor can actually help them pinpoint which is the right diversification that's appropriate for them.
I like the fact that you went into the space of financial advisors. So let's talk about South Africans and their attitude towards a lot of things, right? South Africans have this natural thing where you'll test for your sugar and diabetes if the wellness team is at your employer's offices and they've set up like a wellness, and they give you something in return. They give you a little cookie, or you get a lanyard or a bottle. I don't know what it is. Then they'll go and test. But on a normal day, they wouldn't go out of their way from their homes to go and say, I'm going to go test for diabetes. I'm going to test my sugar, right? So I think it also happens quite similarly also when it comes to investments or speaking to a financial advisor. As part of my employee benefits, is there a value or a benefit that comes with taking up employee benefits that kind of make a financial advisor accessible to me?
Absolutely. So I think these wellness days are a great value add for all employees who who form part of an employer-sponsored fund. And it should be a part of the employee benefits program. And the reason why I say it's critically important, because beyond just talking about health and medical aid, it's also about financial wellness. And having access to advice at the right time can be such a valuable thing to have.
Absolutely.
And I think a lot of people, we all have busy lives. We really, kick the can down the road when it comes to looking for advice. So, it's a really good place where you can be at your place of employment and have professionals there who are willing to sit down with you and able to sit down with you and go through what your needs are. What are your expectations? What are you looking to do? And actually put pen to paper and make a plan out of it.
When I worked in marketing, and the marketing team is here, probably listening, you're from the marketing team, and we always talk about how when companies cut budgets, they first start there at marketing, and they want to cut their budgets at marketing. And and people do the same thing when it comes to the, if like for instance, right now, we having a rise in inflation. We're seeing prices skyrocketing. We're seeing, because of events that are happening globally, the invasion of Ukraine, we're seeing it happen that, it's having a dire impact on South Africans, their pockets. So they need to tighten the belt.
Yeah.
But what many people do is they first go to investments, right, to do that. What type of tips can we give people to say, listen, speak to your advisor? I don't know. Speak to your advisor, find out what's happening. How do we maneuver that situation? Because my worry is that that's where people are going to start first.
Yeah, and it's true. I think when you start having moments of panic, you start making irrational decisions.
Yes.
I think, look, one of the things that came out of the global crisis, the pandemic, was the importance of having an emergency savings account.
Yes.
So for a lot of people, the pandemic brought about very sudden and unexpected events. And I think, it just highlighted the importance of being able to access a pot of money or, a savings account that could see you through some tough times, that was readily accessible, liquid, and I suppose, readily available. And so those things have highlighted the importance. And I think that's stuck with a lot of people. But again, I think, the importance of advice is to steer you in the right direction.
Yeah.
And I think that's another avenue where people should plug into when they speak to a financial advisor. Not only about what's the right structure for you in terms of your investments, but also how to deal with your emotions, how to protect yourself from yourself.
Yes.
And I think, having that rational view can help you make better decisions in those times.
Yes. Tony Robbins, I think his name is Tony Robbins, he wrote a book, something about money mastery game or something like that. And he speaks about an all-weather portfolio. Is that a real thing? Is it possible that your advisor can put together an all-weather portfolal?
So look, I mean, there's going to be times where everything in your portfolio might be impacted by something.
Yes.
Maybe not to all the same extent, but it might be impacted. But an all-weather portfolio, I mean, I haven't read the book, but I'm assuming it's a portfolio that's probably very well diversified.
Yes.
So with the ups and downs, there's a counterbalance.
Yeah.
And I suppose with the all-weather portfolio, what you'd probably want there is a mix of assets or investments that are complementary to each other. They work well together. They're not all moving in the same direction in response to, the market's movements.
Yeah.
So, you have this counterbalance. When one is performing poorly, it's compensated by the good performance of other investments. And so I would assume that that's what he's talking about there.
I want to circle back. I'm going to ask two last questions. One, why are South Africans so afraid of investing, in your opinion? Why do you think? Is it a lack of knowledge, lack of access? What stopped? I mean, a lot of South Africans will say, yes, I'm saving, or they've got like insurance policies that kind of speak towards a saving type of insurance policy, but investing always feels a little far for a lot of our people. Why is that?
So I think to some extent, it probably would be a lack of education. I mean, growing up, I don't think anyone is taught about money. No one's taught about tax, how to be tax efficient. So these things, if it starts at grassroots, maybe it becomes more entrenched, in us.
Yeah.
But I don't think South Africa's particularly out of the norm when it comes to, these behaviors. I just think that, as human beings, we're all about instant gratification. We seldomly want to think about the future. We want to live for the now, and for the now means using money, and as much of it as we have.
Yes.
And so I think that's one of the things. I think if we need to step out of this culture of instant gratification, which is hard because the benefits of saving now for the future can only come in the future.
Yes.
So it's about sharing stories, I think, looking at success stories of people who have saved and where they are now because of those saving habits.
Yeah. Well, you've answered my question then. The question I had wanted to ask you earlier on about, what's up with these unrealistic expectations that many of us have. And I think it comes down to obviously education, right? Now, Alex Forbes has rebranded and refreshed, and you guys have a new, I don't know what to call it, a tagline, but you talk about today's goals and tomorrow's...
Connecting today's goals with tomorrow's aspirations.
Talk to me about that in investing.
Well, I suppose it's, on the back of what we just spoke about, it's really about getting the right savings mechanism for you now so that you can reap the rewards later.
Yeah.
We're ultimately about having people save for their retirement, and we want to see people retire comfortably. Many people in this country don't retire comfortably. And so it's really about connecting them to the right savings vehicles, the right savings plans, the right advice that will guide them through that journey so that they can reach a comfortable retirement. And that's really what we're trying to do. We're trying to connect today with tomorrow.
And I'm going to be quite naughty and give you one last question. I'll ask you one last question. I want you to settle this debate for us. Many people think that retirement, because it's called retirement saving, they think it's a saving and it's savings vehicle and there's no level of investing. Is there any type of investing that happens within your retirement plan?
Absolutely. I would say that is your engine.
Yes.
That is why, besides the benefits that come along with a retirement plan or retirement fund, within your retirement fund, the investments part of it is your engine. That's growing your money. That's growing your wealth. That is earning the capital that you need to have a good standard of living when you do retire. So the investing does take place. It's a very important cog in the whole system. And one that gets a lot of attention.
I'm absolutely happy to hear that, because I think many people think that it's just reliant on, you just put your money away, it's compound interest that's just going to, from a cash perspective, that's just going to grow your money. So it's great to hear that there is definitely a big chunk of investing that happens in that space. But Riccardo, you've been absolutely fantastic. And I think anybody that's watching at home is feeling empowered. And we're going to hopefully have more conversations with you, because we want to talk retirement. We want to talk, how do you put together that diversified basket of investing, even if it's, I'm doing it from an employee perspective, but also if I'm sitting at home and I'm like, actually, I don't think my financial advisor is doing the right thing and I want to steer them in the right direction. So it's been absolutely fantastic having you.
Thank you, Nicolette. It's been really great and it was an exciting discussion. Thank you very much.
Awesome. Thank you and goodbye.